I was sick and tired of losing trades. Every single time my stop loss would get hit, just to see it go my way. That was until I discovered the concept of liquidity. If you want to learn to trade like this and catch real moves, then keep watching. To fill their orders, large players like institutions need to have enough people buying or selling to them. Because remember, for every buyer, there must be an equal seller. And for every seller, there must be an equal buyer. So very often, price will seek out liquidity in the form of stop losses. Long positions that get stopped out turn into market sell orders, which can then fill positions of other buyers and vice versa. Knowing where liquidity is hiding is fundamental to making good trades. And liquidity is a magnet for price action. We call this concept a draw on liquidity. The main idea is to frame the bias, where price is likely to move, and then take trades in that direction. The first area where liquidity can be resting is at support and resistance levels. Commonly, these are equal lows or equal highs. Another area where liquidity is likely to be resting is trend lines. We can assume that some traders might have their stop losses around this area. And most importantly, swing points are an area of engineered liquidity, ready to be hunted. All of these areas are where traders would likely have placed their stop losses based on some form of technical analysis. When liquidity has been tapped, a big move in the opposite direction may occur. We can assume that larger players have filled their position, and this is why the market feels like it's always targeting you. Here's how you can use it to your advantage. When we know that the overall market is bullish, we want to see a retracement down, with liquidity resting higher. This can be in the form of trendline liquidity. You want to see price take out liquidity down first, with confluence of another level like a fair value gap. You can look to long the fair value gap, targeting the liquidity above. Up until now, we've looked at highs and lows as our points of interest. But there's actually another thing that we have to look at in order to truly understand this concept of liquidity. Very often, you will notice how price reverses from these highs, and when they do, they usually are reaching for another objective. And that objective is the fair value gap. All of these inefficiencies in the price chart will get filled either partially or completely before a reversal to the other side. We call this internal range liquidity, and external range liquidity is defined by highs and lows. When external range liquidity is taken, a fair value gap becomes the next draw. When the gap is tagged, an old low or old high then becomes the next draw. We can frame a trade idea based on just this, by first waiting for one objective to be reached, and then take a trade in the direction towards the next draw after we get confirmation. Let's look at one more example where we'll utilize this knowledge of internal and external range liquidity. Here we have the Euro USD chart. We can see that previously it was in a heavy downtrend, but then it started to reverse to the upside after it reached a certain level. We can see the market respecting the bullish fair value gap and bouncing off from it as support. Remember what we've mentioned previously? When external range liquidity is taken, a fair value gap becomes the next draw, and vice versa. We can see that right here on this chart, with each high acting as a form of resistance and the fair value gap acting as support. So, if we want to enter long, we'll have to wait for it to return to that fair value gap and enter once it retraces and target the next levels to the upside. Now, let's switch things up and look at a bearish example. On this chart, we can see how it was previously uptrending, but then it started going sideways and creating equal highs, which is an area of liquidity. So price will likely take out those highs and then reverse to the downside to hunt for liquidity lower. As always, you should first wait for the market to show you signs of a reversal before taking a trade. So here it takes out these equal highs, and then we can see it moving lower, breaking the previous swing low. This is a shift in market structure, and previously it was making higher highs and higher lows. So now the market has shifted from bullish to bearish, and we should be looking for short opportunities. Notice how the market has taken out these equal lows? That's external liquidity. Once external liquidity has been traded through, we'll look for the next draw on liquidity, which is a fair value gap or an internal range liquidity. So here we can see that it has created two fair value gaps. You can play it safe and enter on the lower one, or if you want a higher risk to reward, you can look to enter on the first. As we can see here, it traded below this low and created a new bearish FVG. This is likely to be a hint of continuation for a move even lower. Once again, if external range liquidity is taken out, and then internal range liquidity becomes the next draw, or vice versa. So what you could do here is to add to your short position to maximize your profits. Alright, last one, but stay with me. You don't want to miss it. Because here we're going to be using a high time frame to trade our idea, while the entry will be based on a lower time frame, combining the two. Here you can see that the market is in a sideways range. You might notice that it came from an uptrend, so this sideways price action might be a form of reaccumulation before a continuation higher. If we connect these highs, we can see that it forms a trend line. This is showing us trend line liquidity, and it increases the probability of the market moving up even higher. So wait for the market to take out the opposing liquidity. And again, we can see it trading below these lows. Once it trades above this down closed candle, you want to zoom in to that lower time frame to look for an entry opportunity. Now that we've zoomed in, we can see the same thing happening on this time frame. The market is trading above these down closed candles and creating a bullish fair value gap. This fair value gap will be our entry. We'll enter once it retraces back. We're going to place our stop below the low and target the levels higher. I cannot stress enough how critical understanding liquidity is to successful trading. If you've learned something in this video, share it with another trader that you think might benefit. Make sure to leave a like and subscribe to the channel as we publish more free educational trading content every month. Sign up with our trading partners in the video description below and leave a comment. Let us know what you would like to see covered next.